There you go. Okay, my name is Don Vivrette, and this is week 5 of financial and estate literacy. It's your money. We're going to talk about equity and fixed income investing. As I said to the group before, Pete is not here. He is out of town and unavailable. He's at a conference. And so I am both moderator and host today. So I will play both roles in this. So I'm going to ask Kurt and John to come on board here. Very good. Hi, guys. How are you?
Morning.
Welcome. So you guys are going to take us through this. We talked last week about the general investment world, but you're going to get specific in terms of stocks and fixed income investment. And if you want to talk about yourselves first or bring up the presentation, because I know you're a part of that presentation, I'm not going to push you on going through the specifics of the Ask First form. They're on the website. I can see them right there. So I know that they're here. So why don't you go ahead and bring up your presentation and let's get into it. There you go. Very good.
Thank you, Don, and thank you, Denise. I was at CHOP with my son over the summer, and we had a good experience, first class hospital for sure.
Good, excellent. All right, guys.
So today we're going to talk about equity and fixed income investing, which is perhaps a bold undertaking to put both of these into a single session, but we're going to do our best to get through it. May go a bit faster without Pete jumping in. So to start here, this is, John and myself, we're your two presenters today. Here's a couple highlights of our backgrounds, and you can see our experience in education, and we are two of the principals at Knightsbridge Wealth Management. I know it sounds like we don't need to go through the Ask First forms, but there's John's and mine as well. I think key is, we are a fee-only investment advisor. We are a fiduciary.
So you only function as fiduciaries?
Correct.
Okay. So how do you charge? There you go. No,
Yeah,
I was leading you.
I thought that might be good. Our fee schedule is a little different, I think, than most advisors in that, we found that more of the heavy lifting is done up front with clients, and as they become comfortable working with us over time, and particularly in taxable accounts, as positions appreciate in value and managing that and trying to mitigate tax consequences of selling highly appreciated positions, the workload declines over time. And so we've structured our fee schedule to mirror that workload, and also to reward our most loyal clients. And so you see it declines 5 basis points each year, starting at 1.25%. But for those over $1 million in assets under management, starting at 1.1%, and ultimately arriving at 75 basis points.
But am I correct that if somebody came in with $1 million, you drop down to the 1.1? Okay, good. All right.
And the other nice benefit of this is, client assets should be growing over time, so the lower fee is charged on the higher balance over time.
Very good. Very good.
Okay, so this is what we're going to attempt to cover today. Talk about stock market fundamentals, and then we'll move into the ways we think that you can position yourselves to prosper investing in the stock market. And we'll talk about the current landscape, which I'm sure is top of mind given what's taken place here in 2022. And then we're going to talk about fixed income and really try and first familiarize everyone with key terms. There's just different jargon when it comes to the bond market. We want to make sure everyone's on the same page. Talk about how to optimize your own bond portfolio, and then of course talk about investing in the current market, which given what's happening with interest rates is quite different than it was just even 9-10 months ago. So, So starting with stock market fundamentals, what is a stock? Of course, it's a share of ownership in a business. So if you own a share of Apple, you are a very small owner of Apple stock, and it's synonymous with the term equity. So someone says, what is your equity exposure? What is your equity allocation? They're really asking what percentage of your portfolio is invested in the stock market. There are two types of stocks. The one we'll talk about mostly today, and that is most common is common stock. There's also something called preferred stock. Higher level of dividends. They don't move around as much as common stocks, but basically they're senior in the capital structure to common stocks. So in the event the company does enter bankruptcy, bondholders are paid first, preferred stockholders are paid next, and common stockholders are paid last if anything is left.
Okay.
Basically, for today's purposes, we'll really be talking about common stocks.
Okay.
So, John, why do we invest in the stock market?
This chart illustrates the rising trend in corporate earnings, profits. And the stock market represents, in my mind, the most rewarding area of investment because of this chart. The ownership Kurt mentioned of shares of the company mean you're entitled to a slice of those profits. And since 1935, corporate earnings have risen at about 6.5% per year. And that's really why the stock market has delivered 8 to 10% per year. It's the earnings growth plus the dividends. And the gray bars on this chart represent recessions. Interestingly, are less frequent through time. You see a blip down in profits or earnings during recessions, but they are temporary and give way ultimately to the long-term uptrend in corporate earnings. This is why you invest in the stock market, is to gain participation in those rising profits. These are different ways to invest in the stock market.
Yeah, so there's different ways to invest in the stock market. Of course, you can go buy individual stocks. You can also buy funds, whether they be mutual funds or exchange traded funds. Both of those are essentially baskets of a pool of stocks. So you may own a small share of the fund. The fund is invested. It could be in all the stocks in the S&P 500 index. It could be an actively managed fund. It could be international stocks, but typically it's a diversified portfolio of stocks rather than an individual stock. And the key difference between mutual funds and exchange traded funds or ETFs is mutual funds price once daily and exchange traded funds price intraday, meaning you can trade them throughout the day, buy and sell them just like you would an individual stock.
So if I buy into a mutual fund, I don't actually know how much I have to pay until the end of the day.
Correct. Yeah, mutual funds price at the end of the day.
Yep.
And another difference is with an ETF, you're buying from another market participant, whereas with a mutual fund, certainly open-ended mutual funds, you're buying a share from the fund. They issue and create a new share for you. Of course, you can do so through brokerage firms. You can open an account at Schwab, Fidelity, Vanguard, buy individual stocks, buy funds. You can work with an investment advisor. One thing I would highlight is variable annuities do not count. One of the key benefits of investing in stocks is liquidity. They offer daily liquidity. Variable annuities are highly illiquid. You are locked in typically for a period of 8 years or so, give or take. And so, certainly variable annuities do not count, even though their earnings or performance may be correlated with the stock market. Think about the stock market, one of the easiest ways to break it up is to think about the size of the company you may be investing in. So if you look along what would be the y-axis in this style box here, large companies, mid-sized companies and small companies. Large companies tend to be companies that have a market cap of 10 billion and above. Mid-sized companies in that kind of 2 to 10 billion range. And small companies are 2 billion and below. Everyone defines it a little bit differently, but those are rough guidelines.
What's market cap mean?
And market cap would be the market value of your company as determined by the market, as you're multiplying the number of shares outstanding times the price of those shares.
Okay.
Obviously, the price would fluctuate daily, but shares outstanding tends to be
Right. Stable.
And then, as you're moving along the x-axis here, there's value and growth. Value, everyone defines this a bit differently, but when you think of a value stock, it's typically a more mature business, more stable earnings growth, but perhaps lower growth. And so because of that lower growth rate, they tend to be cheaper than growth stocks. Growth stocks tend to have a higher rate of earnings growth. At times they're unprofitable. So in that case, they'd have a higher level of revenue growth, certainly, but you have to pay up for that. They tend to be more expensive.
Okay.
We have a few rules for you today, and the first one is technical analysis doesn't work. You probably heard that term. It's the idea that you look at price charts, patterns, things like head and shoulders and tops and bottoms, different patterns that you can see in the stock market with stock prices or volume. I don't know anyone who's ever consistently made money using technical analysis. So the first rule today is that that's not how we want you to approach investing in the stock market. This chart is just to give you a sense of how rewarding the stock market been. This is the S&P 500 index, the history of it for over a century, and you see the rising trend, and it's a logarithmic chart. So from 10 to well over 1,000 as an index value. So many multiples of expansion and value of the stock market. And you see all these difficult periods, wars, financial panics, crises, high stagflation. You know, when I get asked, what about Russia? What about China? What about politics? You know, this is kind of my response, that the stock market really is tied to those earnings I showed you earlier, and manages to rise through a lot of different kinds of difficult periods. So the first rule was don't use technical analysis. The second rule is that what you do want to do is apply fundamental analysis. And the idea when buying stocks is you buy them below intrinsic value. Okay, so buying today a company that will be worth more in the future. And to determine that, you want to look at company fundamentals, things like sales or revenue, earnings or profit, cash flow. And so point number 3 is the measures to determine value. You're looking at price to earnings, P to E, price to book, price to sales, price to cash flow. Those are the kinds of things that we spend our time reviewing on a stock. And you can't just look at the stock price. That really doesn't tell you anything. You have to compare the stock price to those fundamentals, such as earnings. And a good example would be, I love Tesla's cars. I like to buy on Amazon. Those are great businesses, but I don't think they're great stocks. And if you consider Tesla, it's growing rapidly. The price to earnings ratio is 54 times this year's earnings. Compare that to Ford, a more mature automobile manufacturer, trading at 6 times this year's earnings. So Tesla is 9 times more expensive compared to Ford. Which is the better stock? And the answer to that is you don't really know until you think about the future of each company and compare the price you pay today to the future earnings. And that's how you arrive at an intrinsic value. So that's the kind of analysis. If you want to purchase individual stocks, you need to not just look at the price, but look at the price compared to those fundamentals.
Are you going to talk about passive versus active investing?
Yeah, I mean, I can speak to it a little bit now. What I just described is active investing. If you're reviewing companies and their fundamentals and trying to buy an undervalued stock, that's active investing. And here at Knightsbridge, we do some of that. We include individual stocks in our portfolios. We also include passive exposure, particularly in taxable accounts. Passive would be, say, buying an ETF that Kurt mentioned. That's a great way to gain investment exposure. It's low cost and it's tax sensitive. So there's no right or wrong. Each can have a place in a portfolio,
right?
But sort of the easy way and a foundational component of investment portfolio can be passive exposure through ETFs.
Okay, thank you.
And if you're doing it on your own, you know, unless you have, you know, a lot of experience, you know, pouring through and handling financials, investing passively is a great way to go.
Okay, yeah.
Take a look at Vanguard.
Yep.
This is more history of the stock market going back to 1960s. Blue bars mean bull markets, red bars mean bear markets. So the obvious thing you see here is that we've had, fortunately, a lot of bull markets, a lot of rising markets. And the current year, 2022, has been more of a bear market year. In the summer this year, the stock market was off 25%, and currently the S&P 500 is down 19%. So it's been a bad year. But perspective, these kind of years we're in right now have been infrequent. The average bear market has lasted 15 months with an average 38% decline. But bull markets have lasted about 6 years on average. So they stretch longer and typically deliver a 200+% return. So generally, I think it's best to be more of a buy and hold investor, a long-term investor, to take advantage of this landscape. At the same time, you do need to monitor your portfolio, and the nature of the U.S. economy has changed over time. This is some interesting long-term history. Early in the country, the stock market was made up mostly of financial companies, and then in the Industrial Revolution, a lot of the railroads, the transports, the blue, and the economy's become more diversified and become much more of a technology-based economy and stock market. And so, you do need to sort of keep track of what's in your portfolio. What kind of stocks do you own, and sectors and so forth. So next we want to talk about how to prosper in the stock market. What do you want to do to be successful? Well, one thing you want to do is diversify. And this is year by year, the returns for different groups within the stock market. And so Kurt mentioned there's growth investing and value investing. The year 2020, look at value, the green, down at the bottom. It was the worst area of investment in the year 2020. 2021, it was the best. Value investing was ahead of all these other types of stock market groups. And so this is part of the reason you hear about diversification across your stock portfolio. Big companies, small companies, value growth, to smooth out your returns, because there's variation from year to year. This is another important chart to really understand how the stock market works, and why you want to generally not panic and be a longer term investor. The gray bars are the annual returns since 1980. And fortunately, most years have had a positive return for the S&P 500. 32 out of the last 42 years have been positive. But during the year, just about every single year, there was a decline at some point, and that's the red dots. And so you have to expect that each year, at some point, your stock portfolio is going to be down 5, 10, 15%. That's a regular annual occurrence. But if you're not selling at that point, typically that gives way, that intra-year decline gives way to what turns into a generally positive full calendar year. Another reason to think long-term is probabilities, the odds of success in the stock market. And if I get asked what will happen today or tomorrow in the stock market, I'll say I basically have no idea. And this is the odds of loss in the stock market going back to 1930. And if you take every single day since 1930, it's been nearly a 50-50 chance that it's a down day. But if you think about all the 12-month periods, so since 1930, all rolling 12-month periods, 70% have been profitable, and only 30% of one-year periods have seen declines. And you go out 3 and 5 years, your odds are even better. At 80% were positive and only 20% negative. And a 10+ year period, 90% were positive and 10% were negative. And that's why you hear about investing for your time horizon. If you have a year or less, you probably, for the capital to be invested, it's probably not appropriate to be in the stock market. But if it's your retirement account or long-term money that you've saved and you want to invest for 3, 5, 10 years, the odds of success are very high in the stock market. It's also important to understand compounding. Back to buy and hold investing. These are historical returns. Stocks delivered about 7% per year over this period. But an investor that held for 5 years their return wasn't 7 times 5, 35%, it was 42%, because if you remain invested, particularly if you reinvest your dividends, you're making money on your money. That's compounding. And so if you remain invested, your compound returns can really add up. On the flip side, I really discourage speculating, buying things just because they're going up, or that you think you might own for a short period and get out when the price is up. You need to know what you are invested in and why you're invested in things, and you need to avoid big losers. The math is pernicious. And this is illustrated here, a 50% decline requires 100% appreciation to break even, because your principal down 50%, you only have half as much to build it back. So we try very hard to make high quality investments in the stock market that will avoid those large losses.
So in other words, at the moment, if the market's down 20%, if it comes back up 20%, I'm not back up to level.
That's right. And we'll show a chart later that addresses that.
Thank you.
It's also a reason why when the stock market is down 20 or 30%, it's usually a good time to be investing at those lower values. I mentioned the benefits of compounding. You see it here. This is the dark blue is price appreciation of stocks since 1980, and the light blue is with reinvested dividends. And so I encourage you to reinvest your dividends. Another favorite question we get asked is what we think politically, and if we're worried about the election. We get phone calls, some people happy, some people unhappy about, whatever happens at a given election. And I remind people that the stock market's done well, regardless of who's been the president, regardless of party control. And you see that here, the blue and the red. And if, statistically, stocks have risen at about the same rate under Republicans and Democrats. In a couple of weeks, we're going to have midterm elections. Historically, in the 12 months following midterm elections, the stock market's done especially well. So I think if anything, there's an electoral argument for some strength in the stock market, but it's not about who's president, really. This is a study that was done of how investors actually did. So you see the bars for different types of investments, houses, commodities, different types of stocks. The average investor, believe it or not, somehow only made 3.6% between 2002 and 2021. Why was that? There's a tendency to be backward looking and want to invest in the stocks that did the best last year, or the types of investments that have been doing the best. And you have to look forward. And generally, the more often you make changes, the less likely you'll be successful, is my experience. That back to being a long-term investor, knowing sometimes you'll have some mistakes, have some losses, but things tend to recover if you have a good, strong strategy at the start and stick with it. Earlier, we compared mutual funds and exchange traded funds. And so mutual funds are these.
Hang on, let me stop you for just a minute. Back up one slide. So on all of these topics that we have down here on the bottom, and I'm hitting on 60-40 versus 40-60 or something else. You work with your clients to say, here's how we think the portfolio should be built based on where your age, your goals, where you are and what you're doing. Yes?
Correct. That would be their asset allocation, which would be established specific to their situation, financial situation, and investment objectives, their risk tolerance. And it changes through time. When clients are working and saving, we're probably much more growth oriented. And once they're retired and spending from their assets, we're focusing more and more on the generation of income and cash flow and taking less risk as the time horizon might not be so extended.
Okay, thank you.
Mm-hmm. So we talked about active versus passive. We don't use a lot of mutual funds here at Knightsbridge, and this is a good reason why. 1 year, 3 year, 5 year, 10 year, 20 year periods, pick your time horizon. Whether you're talking US equity funds or foreign markets, emerging markets, generally mutual funds have underperformed. a lot of them charge high fees. They are often very tax inefficient, taking short-term gains, lots of turnover, and often they manage too much money, they're over diversified, and they can't beat the market. And so I would say, if you own mutual funds, it would be good to understand how they've performed and what they're charging and what their tax realization is. Sort of like compounding, you have to focus on your net of fees return, and also how are you doing after you pay tax. And I mentioned buy and hold investing. Generally, we try to minimize the turnover in our stock portfolio to avoid paying taxes. And the first thing you need to do is get to long-term capital gains for a lower tax rate. And the second thing is try to extend your holding period to avoid the realization of those tax payments. And this illustrates the difference of buy and hold investing. So the dark blue is if you hold your investment for 20 years without selling and paying tax, versus selling something every other year and paying capital gains tax. And starting with $100,000, after 20 years, you have $160,000 more if you earn 6% a year if you did not sell along the way. And that's the power of deferring taxes.
Okay, so now we're going to talk a bit about, current landscape. And so, John, thank you for, providing the background on, how we think you should approach the market from a philosophical.
So you gave him the history part so that everything looks good, and then you get today. Hey, you guys are very nice to each other.
That's right. Well, we're going to talk about
opportunity. There's opportunity.
There you go. I like it. That's a good investment approach.
The recent history has been difficult, but we're going to talk about what. Here in 2022, you might be surprised to know that corporate earnings have actually grown by 5%. You can see that in the box on the right, on the chart on the right-hand side, and the table down below. So S&P 500 earnings have grown year to date. This is through the third quarter. You can see the consensus analyst estimates on the left-hand side of the chart. That's the blue bars going forward. But what's happened is the price that the market is willing to pay for those earnings has declined by 30%. And that's a function of the higher interest rate environment that we're in, right? Suddenly there's an alternative. People can earn 3 to 4% in the CD in the bank, 3% in the money market fund, like you can earn today. Then, not everyone wants to take on the risk of the volatility that comes with investing in the stock market. And so appropriately so, the multiple P, think about a PE ratio, the price to earnings ratio, that price, the P, needs to come down. And so what does that look like today? Well, if you look at this chart here below, you'll see on the x-axis, you'll see the calendar years, and this goes back to the late 90s. You see how expensive the market was on a PE ratio basis, price to earnings measurement, forward PE. You had to go back to the tech bubble, the dot-com bubble, for a time when the market was more expensive than it was coming into this year in the beginning of 2022. And so we were, as you can see, up in that 23 times earnings space over here. It's taken a lot of pain to get here, but now we're right back down to about 15. Excuse me, the historical 25-year average is just below 17. If you take this back 50 or 100 years, it's just below 16. And so we're right back in that sweet spot. We wouldn't say that stocks are cheap today, but they're no longer historically expensive, and they're no longer even expensive. I'd say they're fairly priced. So what does that mean? The fairly priced market. What does that mean for the future?
Well, can I say something for a second? If you go back to that previous chart, this is the price to earnings ratio of the S&P 500, and that's a big part of the stock market. 500 companies weighted by the biggest companies skewed toward those. But there are other stocks, like we showed the diversification. There's mid-sized companies, small cap stocks. The broad market, there are a lot of stocks trading at below this 15 times earnings, and so I think it's a fruitful time to build investment portfolios, stock portfolios I mentioned Ford at 6 times earnings. You know, the economy is soft, so anything that's economically sensitive has come down in price and value. And so if you're thinking about the next 3 to 5 years, I think there's a lot of opportunity to buy stocks, good companies below 15 times earnings.
Agreed. And so what does today's PE ratio tell you about future returns in the stock market? Well, if you look at the left-hand side of this page, it's telling you, based upon if you start with today's PE ratio and forecast 1-year returns, what does that tell you about what's going to happen in the market for the next year? It really tells you nothing. You can see these dots are all over the place. R squared measures correlation. It's very low. What this is saying is expensive markets can get more expensive. Cheap markets can become cheaper. They can stay cheap. And, what happens over the subsequent year, starting today, is really difficult to predict. However, if you look at the right-hand side of this chart, this takes a look at your starting PE ratio and what does that tell you about your future 5-year annualized return going forward. As you can see, the correlation is actually pretty tight. And we started the year over year. Beginning of this calendar year, 2022, the starting PE ratio was forecasting that the stock market was going to annualize between 0 and 2% for the next 5 years. Much lower than history, right? Well, today we're right back into the historical average of that 8 to 10% range. So this is telling you that it's highly likely that the stock market annualizes somewhere in the 8 to 10% range over the next 5 years. And one thing I'll say is, I think there's a lot of concern out there about inflation, and justifiably so. As you can see, historically, the market does best in kind of a 0 to 5% inflationary environment. It's really that once we're up above 5%, which is where we've been for the past year plus, that's a real headwind. We expect inflation to decline, probably slower than most would like, but eventually come back down below 5% and be less of a headwind for the stock market. And as we think about recovery, if you take nothing away from this presentation today, I would take this page away. And this comes back to Dawn, your point about recovering losses. And the reason that if you lose 25%, you have to make more than 25% to get back to even is these are not arithmetic returns. These compound geometrically. And so what that means is this, as of September 30th, we were down 25% from the peak in January. So to earn that back and get back to even, you actually have to make 35%. So what this chart's showing you is if it takes 1 year to get back to the high on January 3rd of this year, that means the market's got to generate close to a 36% return over the next year. Probably not going to happen. If it takes 2 years for us to get back to the January 3rd high of this year, that means the stock market's going to annualize between 17 and 18%. I don't know that that's going to happen either, but I think 3, 4, and 5 years are all on the table. And so what you see here is that implies the market's going to annualize somewhere between 8 and 12%, most likely over the next 3 to 5 years. That's our expectation. And even if it takes us 5 years to get back to the high we were at on January 3rd, that's compounding at 8% for 5 years, which is pretty good. So we don't know, of course, what the next move is. It could be lower. The next 12 months could be a negative return. But if you're a long-term investor and you have at least a 5-year investment horizon, your odds are pretty good of a solid high single digit to even potentially low double digit annualized return. That wraps up our discussion of the stock market into the bond market or fixed income. Starting with the basics here, fixed income is typically used interchangeably with the term bonds. Fixed income portfolio is your bond portfolio. It's a loan to an institution, whether that be a government like a U.S. Treasury bond or a corporation or a homeowner with a mortgage-backed bond, are loaning money to an institution that is obligated to pay you back, and upfront is determined the rate of interest that you will be paid and the date at which you will receive your money back, which is also known as the maturity date of the bond. So if you own a bond, you are a lender or you are a creditor. The issuer of the bond is the borrower, unlike a stock, right? So stock, you're an owner, you're betting on growth. Company needs to grow its earnings for you to be rewarded. When you own a bond, you're betting on solvency. Company just needs to be able to service its debt and pay its bills in order for you to be made whole. All fixed income in a portfolio, you think about the equity portion, the stock portion is really about growth. Fixed income portion is typically thought of for income, providing income. It also provides portfolio diversification, not in 2022, but over time, bonds tend to be negatively correlated with the stock market. And so that allows you to use bonds as a hedge against stock market risk. And they can provide that ballast in the portfolio when there's volatility in the stock market. It's also a hedge against deflation. I think that's something that's underappreciated. It's why bonds have suffered in this inflationary environment. If you're able to lock in a given rate of interest today, and in the future, interest rates decline, the bonds that you own appreciate value because your level of interest is now more attractive relative to the going rate. And then lastly, it's a source of liquidity. We think about that a lot when we're building our portfolios at Knightsbridge is, what are the liquidity needs of this client? And, what, the safest, shortest term portion of the bond portfolio is really used to meet that.
And Don, you brought up, do we customize allocations for each client? Yes. And the liquidity is a big piece of it. And the way I like to think about asset allocation is not really based on your age as much as the liquidity needs. And the bond market is appropriate for funds that you might need in the next few years. And so that's how you start thinking about how much to put in stocks versus bonds. What are your liquidity needs likely the next few years? Because the one thing you want to avoid is selling your stocks when they're down. Middle of COVID, stock market drops 35% in 6 weeks. That's when you sell your liquid bond portfolio, which is not impaired. And that's how I think about asset allocation, is driven by your liquidity needs.
In today's world, the question that has come up repeatedly and has already come up today is, are we going to talk about I bonds?
Happy to. We can talk about them right now. Yeah.
Okay. Either way, the question really becomes realizing the minimum time frame, downsides of owning it, and also would they be a good investment idea to buy for an older grandchild?
It's Series I bonds have been around for quite a while. They've been historically a sleepy investment because the interest rate they pay is linked to inflation, and inflation has been benign here in the U.S. up until two. Today, an I series bond. So today is what, October 20? Where we at? 27th or 8th?
7th.
So you have until October 30th to lock in the current rate. So right now, with inflation high, the rate resets every 6 months, every November and every May. So if you were to buy an I series bond today, your rate for the first 6 months would be 9.62%. Come November 1st, that rate is set to drop to, I think, 6.47, right? Called figure 6.5. So if you blend those two rates, so if you bought an I series I bond today, you would get 9.62% for the first 6 months, and you get 6.5% for the subsequent 6 months. And you blend those, you're annualizing over 8%. Now, the rules Series I bonds are, first, you have to hold them for at least a year. I don't know why you wouldn't at that rate. But if this is money, in your checking account that you may need, understand you have to hold them for a year. And if you sell in less than 5 years, you give up the last 3 months of interest, which we think is a very small price to pay because, as you can tell, there's a lot of forward guidance with the rate. So right now, you already know the rate you earn for the first 6 months. We also know the rate you're going to earn for the subsequent 6 months. So during that 5-year period, at some point, inflation is going to come back down. These will become less attractive. And giving up the last 3 months of interest won't be much of a penalty because it'll be much lower.
But if I wanted to hold it for, let's say, 2 years, I'm paid for the 2 years and no penalties?
No, you would, when you sell it after 2 years, you would give up the last 3 months of interest. If
Okay,
you sell in less than 5 years, you give up the last 3 months.
okay,
So you really wouldn't want to sell until the rate comes down to something that is
right, yeah, okay,
sort of
gotcha.
below what you can get in the market. That October 30th is my understanding. You have to go to the, well, let me start with the main downside is that it's capped annually at $10,000 per individual in your household. So you and your spouse can each buy 10,000 worth each. That's each year. You have children in your, someone mentioned grandchildren. Your grandchildren are part of your household. Yes, you can. The rule is supposed to be they're supposed to be in your household, in your house. You can do 10.
So you can't buy them for someone else?
You can, as long as they live in your house.
As long as they're in the house, okay, they have to be in the, yeah, okay, gotcha.
And then, and so that's 10,000 annually. And they're a great investment. We wrote about this in our quarterly letter about a year ago, last winter market commentary. We recommended all of our clients take advantage of the opportunity. We would do it for clients in their portfolio if we could, but you need to go to the treasury.gov website and you open an account there. And once you open an account, you then link your bank account and then you EFT the funds in. And so if you're thinking about doing it to capture the 9.62% rate for the first 6 months,
Do it now.
I recommend doing it today. Because it takes a minute to link your bank account and then you need the funds to transfer in.
Can I put them in my family trust?
You can. You put them in the name of your living. Yeah, you can put them in the name of your living.
Okay, thank you.
Okay. Key features, we talked about getting, understanding fixed income lingo. The issuer, that is who you are lending money to, right? It could be the US government, the US Treasury bond, it could be Coca-Cola, the corporate bond. You want to understand their credit rating. That tells you the quality of the issuer. And we'll touch on that in a minute. Bond. That's the income stream that's being paid on the bond. Does not factor in the price you're paying for the bond, but it's the income that is paid based on a $100 par value. And so you want to understand what is that rate? What's the frequency? Most bonds pay semi-annual interest. Not all, but most. What is the price of the bond? When does it mature? Which is closely linked to a concept called duration. And then are there any, optionality or call features? That's the issuer's ability to prepay, much like you potentially refinancing your mortgage or prepaying your mortgage. Some bonds allow the issuer to prepay. So maybe a 10-year bond, but they're allowed to call it after 4 or 5 years. And then the most important number, you just want to look at one number for the bond, you look at the credit quality, but look at the yield to maturity, because that is the rate that takes into account both the coupon income as well as the price you're paying, right? So for years, we've been in a declining interest rate environment, and everyone's, so all these bonds that were issued in the 90s and 2000s that were paying 7% interest. We've had clients come in and they own this bond. They say, well, this is paying me 7% interest. And you say, well, no, you paid 130 for this bond, so it's actually paying you 2%. It just, because what happens is you bought it at 130 and it's going to mature at 100. So every year you're losing on the price, which is offsetting a meaningful portion of that income. So you want to yield to maturity will factor in both the price, the coupon income, as well as the price you're paying for that income stream. There's all sorts of different yields out there: SEC yield, current yield, TTM, trailing 12-month yield, but focus on yield to maturity where you can. And this is one downside of investing in mutual funds. If you go to Morningstar, typically they're going to give you the trailing 12-month yield or the SEC yield. SEC is better because that's annualizing the most recent payment. However, whereas trailing 12 months is telling you what is yielded over the last 12 months, which the interest rate environment a year ago may have been very different than today. Two components of total return with bonds, just like stocks: income return and price return. For stocks, the income return is dividends, right? But the lion's share of return in the stock market comes from the price return, the change in price of that stock while you own it. It's the reverse in the bond market. You hold bonds long enough, the price return, it was much lower than the income return, right? You're receiving that income every year. You buy a bond when it's issued and you hold it to maturity, you don't have any price return because all bonds are issued at $100 par value and they mature at that same value. Now, in the interim, price may go up and down, but if you hold that bond to maturity, there is no price gain and your return is the income. Our risks in the bond market, as we've all learned this year, we're going to focus on two today, the main two, interest rate risk and credit risk. But there's some others listed here, prepayment risk, reinvestment risk. Those are closely linked. The risk that someone pays you off and then you've got to go reinvest those dollars now. And we're now in a lower interest rate environment. You can't find a similar bond that pays as much. It's currency risk, that's with international bonds, non-US bonds, inflation and liquidity risk. Those are all really beyond the scope of this discussion. So we're going to focus on interest rate risk and credit risk. So as you think about increasing yield in your portfolio, which was a much bigger concern 10 months ago than it is today, there's really two ways to do so. One is you extend maturity, right? And that increases your interest rate risk. So you're lending money to somebody for a longer period of time, right? It makes sense. If you lend money to someone for a year, you're probably not going to charge as much interest as if you lend them money for 30 years, right? That's the opportunity cost. And so, but as you do that, as you extend maturity in a typical interest rate environment with a typical yield curve, you will receive a higher rate of interest. But your interest rate risk goes up. And that risk is that interest rates rise. And if they rise and you're locked into a bond for 30 years, that's going to be, your bond is really going to suffer in that type of environment. Whereas if you have a bond that matures in, say, 6 months and interest rates rise, that bond's not going to decrease nearly as much in value because 6 months from now, you'll be paid off and you can reinvest the proceeds in the new interest rate environment. Second way to increase yield is to dip down in credit quality, right? Much like we all have credit scores, right? If you go to apply for a mortgage, if you have a lower credit score, you pay a higher rate on your mortgage. Companies are no different, or any issuer of debt will lower their credit rating, the higher rate of interest they must pay. And so, a company like Comcast is going to have to pay a higher rate of interest than, Apple or Disney. So
Before you go on, let me ask you a question in terms of the maturity and the terms that you have. In portfolios that you manage, typically how far out of maturity rate would you go?
To individual bonds, it depends if we're talking corporates, taxable bonds, or municipal bonds. But typically, for corporate bonds, it's 2 to 10 years, and in municipal, we go out to about 15.
Okay.
15 years. Sure.
Okay.
Okay. So, John, you want to expound upon that concept?
This is a good way to visualize the extension of maturity Kurt mentioned. At the end of 2021, this is what the yield curve, the Treasury bond yield curve, looked like. And you see the connection between maturity and yield or interest rate. Short-term Treasury bonds to the left at the end of last year yielded 0. And if you were willing to extend your maturity, buy a bond that you would have your interest rate locked in, say, for 10 years, the yield improved to 1.5%. And if you were willing to lock in your yield for 20 to 30 years, you were moving up toward 2%. That's what, when you hear the yield curve, that's what's being measured, the yield at different maturities. And typically the yield curve is upward sloping. The longer you're locked in for a given interest rate, you're taking more risk on that interest rate. It typically is more rewarding. The very interesting thing about the year 2022 is everything's literally upside down. The yield curve is inverted. And that is very infrequent. It tends to be a precursor to a recession. All recessions have had inverted yield curves, but not every inverted yield curve has met recession. And that's why right now you can buy a 6-month Treasury at 4%. So this yield curve inverted, and yields this year have definitely risen across the board. But most of all at shorter term yields. Kurt mentioned the other way to improve yield is to degrade credit quality to buy a lower rated bond. And here's how you measure credit quality by S&P credit ratings. And there's investment grade and non-investment grade. And so the companies that have the least amount of debt, that have really strong balance sheets, good businesses, tend to trade at high investment grade ratings. There aren't very many AAA credits in the United States, but there are a lot of AA and single A credits. Those are very financially strong companies, highly unlikely to default on paying back their debt at the maturity.
Are there very many AAAs because they have money and don't need to borrow?
That's part of it. That's part of it. Yeah.
Yeah. Anyway, just a thought.
Well, also a lot of the biggest, best companies are tech companies, and they've historically not operated with as much debt. So,
Right. Yeah. Anyway, sorry.
In the current environment, I would want to encourage you to be aware of what are the credit ratings if you own bonds, corporate bonds, not so much municipal bonds, but corporate bonds. Because if you own non-investment grade, BB, and down into C credit ratings, those can default in recessions, in difficult economic times when we have credit issues. And so I'm not saying automatically sell your lower rated bonds, but you might want to review them with your advisor, or I'd be happy to review them for you or with you, because you want to know how risky your bonds are at a time like now.
Yeah, and this chart is not to scale. And what I mean by that is AA bonds, for example, tend to be fairly interchangeable, both from the yield that they offer as well as the credit quality. Whereas you get down to like BB, there's a tremendous amount of gradation in BB. There's the higher quality BB rated bonds versus the lower BB bonds are very different from one another, both in the yield they offer as well as their credit quality. So now we're going to talk about how to optimize your own bond portfolio. I think, John, best way to do this, why don't you talk about how we'll go through each category here, and these are our 5 key tenets to managing your portfolio. And John can talk about what we do, and I'll tell you what I think you should be doing if you're doing it yourself.
Well, here at Knightsbridge, we manage stock portfolios, bond portfolios, but mostly portfolios that contain both stocks and bonds. They serve different purposes. The bond component of portfolios, big piece of success has been minimizing costs. The higher yields go, that's less critical, but certainly it has been very important to keep costs down with interest rates that have been on the low side. How do we do that? We buy individual securities. We buy corporate bonds. We buy municipal bonds, depending upon tax bracket. And that's the second element to how we think about bond portfolios. It's important to know what your after-tax yield is on bonds. And if you're a high income earner, it's probably appropriate, particularly in California, to buy municipal bonds. If you're not such a high income earner, then corporate bonds might offer a more attractive yield. But the key is your specific tax bracket. And so when we decide what type of individual bonds to buy, we make sure we understand the client's tax bracket, and your bracket may shift through time, which means we might change what type of bonds are in your portfolio. And as I mentioned earlier, the bonds are about liquidity. And so in my view, it's not, the risk reward is not conducive to buying risky bonds. You're not compensated adequately to buy the longest term bonds or the lowest credit bonds. So we tend to view bonds as more about preservation of capital, liquidity, and safety, risk reduction. And so that tends to be, as Kurt mentioned, we ladder bonds, buy some bonds that have a maturity in 2 years and in 4 years and in 6 years, that sort of thing, so that if interest rates rise through time, we have maturities coming up and we can reinvest. And so that's how we think about balancing income and liquidity. And another aspect of improving yield is buying public fixed income and also private fixed income. So we access the private markets through, say, real estate, a real estate lending fund that makes loans that are backed by real estate that offer yields above what you can get in a corporate bond. And so best yield will come from a broad spectrum of fixed income. And as I mentioned earlier, definitely important to think about how much fixed income or bond exposure you have and match it to your personal financial situation and your liquidity needs. And that's something we try to always make sure we're informed on and in touch with year by year with the client. That's how we do it.
You are doing it yourself. I think you're, rather than building a portfolio of individual bonds, I think you're really best off buying a diversified total return bond fund. We'll talk a little bit later about some ideas, some actual specific funds you can buy. I want to focus on buying the most cost-effective share class. There's many share classes out there. Typically, the institutional share class is the cheapest that you can access, but many times that comes with a transaction fee that you pay at your custodian. And so you want to understand, what is the size of this position? Is it worth paying the transaction fee for the expense ratio? Or am I better off paying a higher expense ratio to avoid the transaction fee because this may be a small position, or I may not be holding it for a long enough period of time to realize those cost savings in the expense ratio? So first, you want to think about the tax environment, right? Is this a retirement account that you're buying the fund in, or is it a taxable account? If it's a retirement account, you want to buy a taxable bond fund because the yield is going to be higher. You don't have to worry about tax consequences. If you're in a taxable account, then you really need to be thinking about your income tax bracket. Kind of the federal 32% bracket is kind of the dividing line. Once assuming for California residents, you layer on California 9-10% rate on top of the 32 federal. Then you want to start thinking about municipal bonds, and that's what we call high bracket. Municipal bonds are nice in that the interest for California bonds is both federal and state tax exempt, and so those can be very beneficial on a taxable equivalent basis. Typically, will do better in municipal bond. As John mentioned, balancing income and liquidity is key. Money market pays 3% right now, and the Fed raises rates next week, as we expect. It's probably going to go up a bit. So that's not a bad option right now for money that you're going to need near term. And there's short-term bond funds, because the yield curve's inverted right now. Short-term bond funds have decent yields as well. So you can think about supplementing or moving a portion of your portfolio to shorter duration if you're uncomfortable with the level of interest rate risk in your portfolio. But when we talk about liquidity, you want to understand your fund, how's it generating its yield? What's the liquidity of the underlying positions in that portfolio of that fund that you're buying? When it comes to doing it on your own, I think you probably want to stay away from private investments unless you really have done your due diligence on of that private investment. There's really attractive yields that can be generated, particularly in light of the credit quality in some of the private investments, what we call the liquidity premium that you capture. Like you're typically locked up for a year and really have to do a meaningful level of due diligence on the provider. So I think I would recommend, in today's interest rate environment, the publicly traded fixed income market offers, I think, compelling enough yields that steer clear of the private markets for now on your own. And no difference doing it your own versus how we do it when you're seeking to identify your optimal allocation. You're really balancing your liquidity needs as well as your overall tolerance for portfolio volatility. If you don't have any liquidity needs, what's your optimal fixed income allocation? It's however much you need in your portfolio to prevent you from selling in March of 2020 or March of 2009 or March of 03 or October of 87, when the market tanks. If you feel, if you're not able to stomach, the drop in your portfolio, that tells you probably needed more fixed income in there. That's just managing your overall emotions, which can be honestly the most difficult part of managing.
Let me take you slightly off topic, but because I bonds have become such a popular item, it's an interesting question that's come up. Do you have the ability to name a beneficiary for an I bond?
Don't know. I'm
There's
not
your answer.
sure.
Not sure. Okay,
I
gotcha.
believe you do. I can't recall.
No.
Yeah.
Not
But one thing I
uncertain
did-
is it
One
is
thing
an
I did
answer.
fail to
Right?
mention is the interest is state tax-free, which is meaningful in California.
Okay, thank you.
When we review an investor's income-oriented portfolio, we're usually able to make recommendations that can improve the yield on an after-tax basis in a fairly straightforward manner just by evaluating that investor's tax bracket. Because so often the fixed income is purchased without consideration of the tax situation. And so it's really important to manage to a tax bracket. And here's a good example. Many people think they pay 20% as a capital gains rate, but this is actually last year's brackets on capital gains. For 2022, a couple can have up to $517,000 of capital gains before they're paying 20%. Most people are at the 15% rate. And so we can make fixed income investments that are actually taxed at the capital gains rate. And so for that investor, if we establish that sort of fixed income, say preferred stocks that are paying qualified dividends that are taxed at 15%, and that investor has a $300,000 income, we just cut their tax rate in half on the income. And so if there's a preferred stock that pays 6.5% currently, that's taxed at 15% federal, that's a really good after-tax yield. And that's the way to think about your income, is net of tax. This year, I mentioned the yield curve is inverted. You see that to the left, the gray Treasury yield curve. That's a current or recent yield curve. And it's downward sloping from a Treasury standpoint. The municipal market has an upward sloping yield curve and a nice extra tax equivalent yield for a higher tax paying client. And so we've been interested in municipal bonds because of the upward sloping curve, especially when you look to the right, the federal debt versus most state and local debt as a percentage of GDP. So we believe municipalities are in decent financial shape and offer after-tax yield that's superior to the Treasury market currently for most higher income earners in California.
Okay, so we told you we'd give you some ideas for doing it yourself. So this top box up here, some of the options that we like if you're doing it yourself. The first three, Fidelity, PIMCO, and BlackRock total return bond funds. They're all these are taxable bond funds. So these would go in your IRA, or if you are in a lower income tax bracket, then they would go in your taxable account as well. First daily liquidity. This is just your standard diversified core bond fund. They tend to be comprised of roughly a third corporate bonds, roughly a third mortgage backed and asset backed, and roughly a third treasury. And they'll move the weightings around over time. But these are three that, BlackRock and PIMCO and Fidelity, those are three of the biggest bond managers, probably along with Vanguard in the world. So those are really good options. Also, if you're in a high income tax bracket and you're thinking about a taxable account, down at the bottom, Vanguard is a great option. I'd probably go with Vanguard. You look at the expense ratio towards the right-hand side. It's only 9 basis points. I know everyone, you think of Vanguard as, pioneer of passive management, but even Vanguard recognizes that in fixed income space, value can be added through active management. So, there are a lot of their fixed income funds are actively managed, including this one. Uveen is also a very well-respected manager of fixed income in the market. I've added 2 other funds in here, 2 BlackRock funds in the middle. You'll see, for those of you concerned about interest rate risk and you want to go with shorter maturity bonds, shorter duration, the BlackRock Strategic Income Fund is a decent solution there. And then for those of you who are willing to dip down in credit quality and want to add a satellite position, BlackRock is certainly the best player in the high yield bond space. High yield bonds are synonymous with junk bonds. So understand those are lower credit quality, higher default risk, higher credit risk issues that are in that fund, but you receive a higher yield. Right now, the yield to worst in that portfolio is 8.9%. So it's a higher yield. I would not go crazy with that fund. If you're building a buy and hold portfolio, of your total fixed income portfolio, I would limit that to 10%, just to be prudent. And I would have no problems with you omitting it altogether and just sticking with the Fidelity, PIMCO, and BlackRock total return funds. Of those three, I'm most partial to Fidelity. It's been a great performer over time. So Fidelity, and then on the tax exempt side for high income earners and taxable accounts, that the Vanguard fund is my selection.
I wanted to give
go
you a
ahead.
sense of how we build income-oriented portfolios at the bottom of this page. The important thing, I mentioned the tax bracket considerations, and that informs the vehicle or the account we choose. And you see the column that says optimal account to hold. Some investments are best in a taxable account, while others should be made in an IRA. High income investments, we generally want to tax shelter in an IRA. And so we'll put things like corporate bonds and other higher yielding investments in an IRA. And so hopefully you've arranged your income exposure accordingly. 2022 has really improved yields. You can see here there are opportunities to earn on an after-tax basis, mid, even up into the high single digits. And better yields tend to come when able to give up based on a time horizon daily liquidity. You see some of our income investments have quarterly liquidity, and in the real estate case require a 1-year commitment to investment. And typically clients have the ability to portion some funds such that they're not daily liquid, and there's a reward for giving up that daily liquidity. And so we oftentimes accept that less than daily liquidity to improve the yield. So think about what type of fixed income you own and where you own it, informed by your tax bracket.
Also, just for those of you looking at the details of this table, understand that after-tax yield is based upon it being held in the optimal account. So if you hold corporate bonds in a taxable account rather than your IRA, the after-tax yield is of course going to be low. So now we're going to move on to current state of the bond market. So we talked about the stock market as we're in a bear market, but as John talked about, it's pretty common. Most years the stock market does decline peak to trough, somewhere between 5 and 15%. And every 5-6 years we go into a bear market. The bond market, on the other hand, what's been taking place, this year has been anomalous. So we start out, I was born in 1981, and just as Reagan was getting the hostages released in Iran, and this has been certainly the worst environment for bond investors in my lifetime. This chart is a little stale in that it shows the bond market down, just under 14%. Today it's down nearly 16%. And so, this is not.
So are you saying don't invest in bonds?
Say that again.
So are you saying don't invest in bonds because it's down every year?
Saying it's not down like this. This is very rare, and we'll talk about what that means going forward.
Okay.
For everyone on this call, this is also the worst period for bonds in your lifetime. You really have to go back to our founding fathers' bond portfolios to think about increased pain, more pain that was suffered than what we're going through here. That was a time when country had a lot of debt financing the Revolutionary War, and Treasury yields spiked. Here in 2022, right now, depending on which market you look at, take a look at this middle column here, the red column. That shows you all the carnage. Top half of this table is the treasury market, right? So, even a 2-year treasury down 4.5%. Now, this is as of September 30th. And so, bonds have actually declined a bit here in October as well. So the numbers are all a little bit worse for most of these sectors. And then down below, you see various sectors in the bond market. So US aggregate, that is the broad bond market. So when you think about those total return bond funds I told you about, Fidelity, BlackRock, PIMCO, those are all benchmarked to the US aggregate. It's been a very painful period. As you can see, there hasn't been anywhere to hide. On the bright side, if you look at these two leftmost columns, you see the starting yield on December 31st, beginning of this year, and then you see the yield as of September 30th. Pretty much all of these are up 3 to 4%. So when we were back in January and we were building a high quality diversified bond portfolio for clients, we typically were getting somewhere around 2.75% to 3% in that portfolio. Today, we're getting closer to 6%. It's more like 6%. So going forward, yields are much healthier, and you should expect more from your bond portfolio. What's probably the most extreme example I can point out here is if you look at the 2-year treasury on this chart, as of September 30th, it was paying 4.22%. That's 1 basis point more than a junk bond was paying at the beginning of the year. That's how swift the rise in interest rates has been. And as we sit here today, that this rate it's bounced around a bit, but it's been even higher than this. It was up in the 4.4s for a lot of October. So the good news is going forward, there's a lot more to be had in the bond market, right? And this is just another reflection of those moves higher in yields. And this chart's actually a little bit stale. These are all in the 300 basis point range now. Why is that important? The starting yield in your bond portfolio is actually a really good predictor of your return over the next 5 years. So just is even more so than your starting PE ratio is for your stock portfolio. And that's because if interest rates rise and the value of the bonds you hold declines, that's offset by the portion of your bond portfolio that's maturing and reinvesting now at higher rates. And conversely, when interest rates decline, the appreciation in the bonds that you hold is offset by the fact that the shorter term bonds you own, as those mature, you're now reinvesting at lower rates. So the correlation, as you can see, this blue line, this is the yield, the average yield on the bond market index that we just talked about. And the orange line is the subsequent 5-year return based on that starting yield. That's why we have another 5 years here of the blue line that we don't have the orange line, is because it's yet to be determined. But I can tell you it'll follow pretty closely. So you should expect going forward, annualized return over the next 5 years, you should expect something, in the 5s. If you're not adding, high yield or private markets or anything like that. If you're just buying a vanilla diversified total return bond portfolio, you should expect 5% over the next 5 years annualized. John, I'll let you talk a bit about our firm. That wraps up our bond portion.
Sure. Just a bit about our firm. As mentioned earlier, we're a registered investment advisor, and that's important. That means we have a fiduciary duty to our clients, and we're a fee-only advisor, providing investment management and financial planning. I helped found the firm in 1998, so we have a 25-plus year history managing 500 million plus. And Kurt and I are 2 of the 3 owners of the firm. And Kurt and I work together to review investment portfolios, build portfolios, and sit down with our clients regularly to make sure they understand their investments and that they're appropriate. And there's nice continuity there, and that we're the owners of the firm doing that. And we really tailor each client's portfolio, their specific accounts, to the solutions that meet their needs. And most importantly, we're always invested alongside clients. So something I believe is very important, that if it's good enough for a client, it's good enough for us as well. we've touched on some of these hallmarks of our firm. We try very hard to minimize costs and be very tax efficient, accomplishing that by doing the investing oftentimes in-house with individual securities. And we only look to active management or private markets where it makes sense. Otherwise, we're going to go passive and index to keep the costs down.
So our typical client, it's someone who wants to have a plan in place for their financial security that's tailored to their situation and their goals. They may be questioning the sophistication of their investment portfolio. They open up their statements and just see a basket of mutual funds and perhaps ETFs, and they're looking for something beyond that that takes their tax bracket into consideration in their after-tax returns. And they also want access to the people who are making the investment decisions, as working with a boutique, as opposed to a larger organization where they're working with a representative. So as we've mentioned, we are fiduciaries. We are analysts. We have multiple CFAs, chartered financial analysts, on our staff. So we are able to offer that in-house individual security selection with stocks and bonds. Our money is invested alongside our clients, and we are 100% independent employee owned. That, I'll just wrap up by saying that, if anyone is interested in our thoughts on their portfolio.
That was the question I was about to ask you. Go ahead.
Yeah. Happy to, we provide detailed written portfolio assessments, commitment free. I mean, there's no cost. It's just to give you some insight into what are the expenses you're paying, are there tax inefficiencies, what is your bottom line performance net of those inefficiencies and costs. So happy to do that. You can see John's email and my email address as well as our phone number. So feel free to shoot us an email. Really, all we need is an account statement, and we can put together a thorough review for you.
So you would need a statement on what their portfolio is today.
Correct.
Okay.
And
do you need to know what their goals are?
Preferably with the cost basis if it's a taxable account.
Okay. Do you need to know what their objective is, or where the age or anything else with it? Or you just you're giving them a report on what the status is of their current portfolio?
Yeah, the more information we have, the better.
Okay. Very good. Why don't you stop sharing your screen?
Okay.
There you go. Okay. We have no other questions. We've asked them along the way and gotten answers for them as we work through this. So I appreciate very much what you've done. I think you've covered it very nicely. Pete would be proud of us. We ended exactly, we have 2 minutes left.
Right.
The important part of this is really understanding where an individual is. And you do that with clients in terms of looking at a portfolio for them, as you said, tax, non-tax, where you are in your lifestyle, what else is going on, what your needs are. And that's how you help build a portfolio for them. And people say, should it be a 60-40? Should it be this or that? And the answer is it depends. I mean, having watched enough of these now and observed them in person, my key thing is when someone asks a question, I tend to say it depends because of the number of lawyers I've watched do presentations. And in many ways, it's the same thing with investment. It depends on your situation, and everyone's unique. And so there isn't a standard, this is the answer. No, it depends on the individual. And that's what you're very good at doing. So I thank you very much. Let me just do a quick wrap up. This has been Financial and Estate Literacy, Week 5, investing in equities and fixed income. I thank both of you very much for helping us. I'm going to stop the recording.